Okay, chapter 2. And let's start with chapter 2. This is accounting 1110, principles of accounting, first part. We're still dealing with the first part. We're not going to go to the second part until we finish this part. So it's chapter 2, and let's see how we're going to deal with the transactions. Once we saw what accounting is, let's see how we're going to deal with the transactions. Now, again, let's remind ourselves what we're doing here in this course. We're trying to do accounting, and accounting is the process of different transactions which are put in the form of recording in the system, and through that system, we're generating different type of reports for different users. The main users of the accounting are the outsiders, which are creditors and lenders. They are more concerned about what's happening in the company because they also want to make money through the company, which makes money. So that's why they're interested in, is the company generating income, which we can find on the income statement? Is the company, once the company generates income, where that income is? That's why they're looking for statements of shareholders' equity. And once they see what's the shareholders' equity, they want to see what's the assets that this company has and how the assets are acquired through the liability and the owner's equity. So the accounting cycle, which is going to produce the reports which are useful for the users, is going to start again with every report is going to start with balance. Usually, if we start the company from very the beginning, those balances, everything will be zero. So since it's the start of the company, the balance will be zero. Once we move to the first year, those balances going to change, and they're going to change year after year. But in the very beginning, everything starts from zero. Then there's a transaction or events which happen in the company. Once the event or transaction happen, what we have to do, we have to identify and analyze, is this transaction actually happen? Is that transaction affect the company? Is that transaction related to the company? And can we measure it? If we can do that, then we need to record these transaction in the journal. Once we record it in the journal, we combine all the journals in different, that will be different accounts for every account that we may have in the company. We're going to put those accounts, all the transactions on the journal on the certain account. Those accounts, we're going to put them in the ledger, which a ledger is going to combine all the accounts what the company has or needs for the recording of the operations in the company. After that, we're going to prepare this unadjusted trial balance, which technically we're going to take the balances from each account and we're going to put it on one sheet so we can see what the company has on each account and what's the balance of each account. Then we're going to prepare and post the journal adjusting entries. Some of those balances has to be adjusted to meet some requirements. We're going to see what the requirements are. And then we can prepare the unadjusted balance. Once we prepare adjusted balance, we're going to prepare financial statements. After preparation of the financial statements, some of the accounts has to be, we start preparation for the next period. Some of the accounts has to be closed. We're going to close those accounts, going to prepare the after closing or post-closing trial balance to show us is the accounts that we need to close are actually closed. And if the balance, we have to reset some of the accounts down to zero. So we can start accumulating new information during the new period. And we're going to continue the new period again. So today what we're going to do, we're going to identify and analyze if the transaction happened. Then we're going to record the transactions in the journal. Then we're going to see from the journal, we're going to post it into the ledger account, prepare unadjusted balance. Next time in chapter 3, we're going to start journalizing, posting, adjusting entries. We're going to prepare adjusted balance, and prepare financial statements. And in chapter 4, We're going to start closing those. Some of the accounts on the adjusted trial balance has to be closed and prepare for the next period. So that's the everything that we're going to do before the midterm, and then we're going to do the midterm on all those ideas. So let's go first. Accounting. In the accounting system, we're going to have a different account. Account will be, think about like a sheet on which sheet we're going to explain what activity happened on the certain account. So we go when we explain for each account what happened in that particular account, we're going to put it in one place, and that's going to be our ledger, which combine all the accounts on one place. Each account is going to have a balance, and when we pull a list with all the accounts and all the balances, that's going to give us the trial balance. From the trial balance, then it's going to start bringing the information. So we're going to put the account for different purposes. We definitely want to keep track of cash. That will be a separate account. We're going to keep track of accounts receivables, how much we have to collect, from whom we have to collect, and why we have to collect, and how much we have to collect. Accounts payable, how much we have to pay, to whom we have to pay, why we have to pay, and when we have to pay. And the capital, which is the owner's capital, how the owner's capital moving from one period to another period, or some transactions that might affect the owner's capital. When we having all those different accounts, when we put it in, we're going to put it in one single place, and that's called ledger. Now, in the accounting software, we're going to have a different accounts, and then we're going to, in the system, we're going to put all the information, and the information for different purposes is going to give us different information. To make it simple, we're going to number those accounts. We're going to list them, and we're going to number them. Put the name, and see how they behave. So the logical order is everything which starts with number 1, we're going to call it asset. Everything that starts with number 2 will be liability. Everything that starts with number 3, those accounts will belong to the owner's equity. Everything that starts with 4, those accounts will be revenue accounts. 5, here we can say 6, 7, and even 8 are reserved for the expenses. The easiest way to remember it is very simple. I'm going to open one Excel spreadsheet. Just give me a second. I'm going to open one Excel spreadsheet, and we're going to look at that Excel spreadsheet. And that will be easy for me to explain it. Try to find one Excel. Everything starts with the basic accounting equation. If you remember it from the last time, the basic accounting equation. The basic accounting equation, let's make it even bigger, is assets are equal to liability plus equity. Leave some space here between those two. And equity here. So that's the basic accounting equation. We already know that. So why do we need that basic accounting equation? Because that's going to give us from where the assets came from. Do we have to pay somebody? Because the liability comes from creditors and lenders, or everything that the company has belongs to the owners, which is the investors. The other thing that the other thing that we want to know from the operation of the company, we want to know if the company generates revenue and how much the company expenses are. And obviously, revenue minus the expenses is going to give us net income, which net income is going to go directly to the owner's equity capital account. So the easiest way to remember it, since the accounting equation starts with asset equal to liability plus equity, we're going to start with assets are first, so they're always going to be number one. Liability at the second, number two. Equity is the third, number three. Revenue comes from the operation, that's number four. Expenses are 5, 6, 7, 8. All those are expenses. So that's how you should remember the logical numbers of the all the accounts. So again, every account that starts with number one, that's reserved to the asset. Number two is liability. Number three, that's equity. Number four will be revenue. And number five, number six, number seven, number eight are reserved to expenses. So if you see account which start with, again, with one, is let's say the account number is 152, that definitely is asset account. If the account is 300,001, that's equity account. Now, the other thing that through the account number under the assets, you can have a different accounts. Depends on the number of the accounts and depends on the company that you're running. That's going to determine how many numbers you may use for the different accounts. Obviously, if you have in the assets account, you're running it from 1 to 10, then you have only 9 accounts that you can use for the assets, or 10 accounts to use for the asset. And then you're moving to 20, which is liability, then have another 10 accounts for the liability, and then moving to the next one. Actually, the 10 will be assets, and then gonna have 11 will be cash, and keep going to 19. Those are only 9 accounts. So in order you to have more options for the different accounts, that's why you have start with the bigger number. So if I start, if my number 1000 start with asset, it's related to the assets. Now I have 999 options and choices for asset accounts until I go to 2000. Because everything that starts with 2000 is going to be liability. Now, that's one option. The other option is I to have 10,000 start with assets. Now, the next number that I have is 20,000. That's a liability. So you can see now, in this case, I have a way more option for the asset accounts compared to this scenario. The first scenario will be if I have only 100 and 200, right? That's why sometimes you're wondering why the number of the asset account is too big, so they can have more options to choose a different type of assets within the this classification, which is the section with the assets. That's why. So let's move to the slides now. Again, for the accounts that start with 1, again, asset, 2, liability, 3, owner's equity, 4, revenue, 5, 6, 7, 8, expenses. So that's how you're going to see it. As you can see, this company using thousands. So they have 999 options for assets. And 1100 is cash, 1200 accounts receivable, 1400 office supplies, 1500 furnitures, 1900 land. As you can see now, within the 11001, I can have 1101, which can be Canadian dollars, 1102 US dollars, 1103 some other currency. I can go that direction, or I can have 1101 TD Bank, 1102 Royal Bank, 1103 some other bank. Or you can go with 1110 TD Bank, 1111 TD Bank Canadian dollars, 1112 TD Bank US dollars, 1113 TD Bank some other currency. And then can go 1120 RBC. 1121 will be RBC Canadian dollars. 1122 RBC US dollars. When we go to the accounts receivables, you can have 1200 accounts receivables. 1210 is going to be this client. 1211 another client. And keep going, keep going, keep going. So the same idea with accounts payables. As you can see, between the accounts payable and notes payable, you're leaving a distance. So now I can plug here from 100 to 299. So I can have 299, that will be 199 accounts payables, different type of vendors that I can keep track of. For the revenue, service revenue, 4,000. Owner's equity, 3,000. Owner's equity, the withdrawals, 3100. Expenses, we can have so many expenses. And expenses for different purposes, in different reasons, you can put a different type of accounts and different numbers of the accounts. But that's how you're organizing the account system. The whole idea is in the very beginning, since you don't know, you haven't seen the big picture, is kind of tricky for you probably, or for anyone, even including me when I was in your shoes or in your place, to picture all those things. But once you start developing the sense of accounting and the sense of logical classification of the numbers and how the future can grow, then you're giving yourself, you start preparing yourself the right chart and right map, so that map can catch all the information that's start coming into the company. Basically, this is not any different than keeping track of a library, right? You have so many books there, but you try to put them in different sections. And each section, you try to find some way so you can find easily what you need. Same idea is in accounting. You try to set up everything in the logical order and with the right numbers and names. So if you want to some information, you can easily extract it. That's the whole point with all those numbering. So now let's see how we're going to track changes in each account. Now we're going to track it with double entries. Why double entry? Because we're always going to have debit side and credit side. Or basically one side's going to give a rise, the other side's going to decrease. Or one side's going to go up, the other side's going to go down, or one side can go up and the other side can go up. Depends on the accounting equation, where they are and how they are. So the simple way you to see it, we already saw that one in chapter 1. Let's think about the cash. Now, in the very beginning, the company doesn't have a cash. Now, the company has to cash cash. But since the owner is the one who's going to provide the first cash, then there'll be two accounts will be affected. One will be the cash, the other one will be owner's capital. In this case, since the owner is treated as a, from the business perspective, he's outside of the business. He's not related to the business. I mean, he's run the business, but he's not, the business technically owns him money. So when he invests the money in the business, the cash in the business is going to go up. But now the business owe money to the owner, which is going to be keep tracking his capital account. Now, as long as he has a capital account, there should be assets that's sitting against that capital. If the capital disappear, obviously there will be no assets. But as you can see, always two accounts are involved in that transaction. Let's put a transaction of this event where the owners put cash in the business. Now the business has cash. Now we're going to start doing some transactions with the cash. Once we have cash, we can start buying things. Now, if we buy supplies here, for example, now before we buy supplies, we have cash, but we don't have supplies. Once we buy the supplies and paying with cash, now we don't have the cash, but we have supplies. Now, if we decide not to pay, then we're going to have what we're going to have. The cash is going to stay. We're not going to touch the cash now. We're going to buy the supplies and we're going to promise the vendor that we're going to pay after 15 days. So now we create a liability for ourselves. So in that case, office supply is going to go up and the liability is going to go up, right? Instead of decreasing the cash. But eventually we have to eliminate that liability by reducing it to zero. But then we have to move the cash out of the company and bring it to the vendor. So that will eliminate our liability. Same thing with the truck. If we buy a truck, now we have two options. Either we can pay it right away, either we're going to pay in the future. If we pay right away, we're going to get the truck, and now truck become part of the business. So the business account for the truck goes up. If we pay cash, cash goes. But if we don't pay, then we have liability that we have to pay later. So that's how we're going to differentiate it. Obviously, the T account, let me go back to the Excel spreadsheet. Now, the T account is the interesting concept. The T account, again, each of those accounts, asset, liability, equity, revenue, expenses, we're going to set up accounts for those. Now, asset is the general category which is sitting on the left side of the equation. But under asset, we're going to have a different type of assets. Liability, again, is general term for all the liability that the company can have. But we're going to name each liability different way. Same thing with the equity, same thing with revenue, same thing with the expenses. When we start with the accounting equation, let's move to the next worksheet. When we start the accounting equation, now those numbers are irrelevant. Let me erase them. Accounting equation always going to be essential, always going to go first. Once we have the accounting equation, then we can think about the other things. So, in order to make it easy for us, we're going to set up a T accounts. What's a T account? T account looks like something. Let me make everything even, so I can play with this cells here. 1, 2, 3, 4, 3, 4, and 1, 2, 3, 4. Okay, I have. It's gonna look like something like this. Let's put here on the assets. We're gonna make it like a T account. And the T account is going to look something like this. Now the asset account on the left side, we're going to call it debit. On the right side, we're going to call it credit. Make it a little bit more bigger. This. And I'm going to drop down everything to be not that big, to be 26, like this. So everything's going to have its assets going to have accounts, liability is going to have accounts. Let's put under the liability accounts. Equity is going to have accounts. All those is going to have accounts. Now the question is, each account is going to have their normal balance, and each account is going to have debit and credit. The question is, how would we know which is a credit and which is a debit, and what the debit is, what the credit is? Now that depends, always depends on the accounting equation, on which side of the accounting equation we are. As you can see, the accounting equation is split by this sign here, which is equal. Let's merge those one. So what that means? That means if we draw a line here where the counting equation is, let's draw this line here under the counting equation. And make it look like a T account, like this. Now I can see it looks like a one ginormous big T account, isn't it? Let me get it thicker. This, and there will be one line here. So if you want to make this one thicker here, I can go to format cells, and let's format the cells, borders, and let's get this border point here, and that should do it. Okay, now we have this big ginormous T account. Actually, this one I don't need it on the top. Let's eliminate only this. Okay. So what we know about this account? On this account, again, this side will be debit, on this side will be credit. What that means to us? That means that all the accounts on this side of the equation all those accounts are going to have normal balance debit. That means the assets beginning balance is going to have debit, ending balance is going to have debit. BP is beginning balance, EB is ending balance. So now we know that the assets always going to have debit balance. No exception. If we're on the other side of the equation, on the big ginormous equation, we know that those accounts always going to have a credit balance. So beginning balance of those accounts will be on the credit side, and ending balance of those accounts will be on the credit side. What else? What that gives us? That gives us that every time when in order to increase the asset, we have to put it on the debit side. And if you want to decrease the asset, we have to put it on the credit side. Since we're on this side of the equation. Now, on the other side of the equation, if we want to increase the liability, we have to put it on the credit side. Same thing with the equity. And if we want to decrease the liability, we have to put it on the debit side. So let's see the first transaction that we talk about it. For example, the first transaction was in the very beginning. We know the company. Let's say this is a cash, and this one is capital. Let's say owner's capital. So what's happening in our case? In the very beginning, when we open the company, there is no cash. We already know about it. There is no cash. And there is no capital for the owner. So the cash is zero. Owner's capital is zero. Now the owner investing, let's say $10,000 cash. Everything that the owner is going to invest is going to increase the cash. $10,000 cash coming in. But that also is going to give effect on his account as well. So his account is going to go up. Now, in order to be in balance, if here on the it's on the debit, if you want to be in balance, that one has to go on the credit side. Because one thing that you have to know about accounts is debit always have to be equal to the credit. Same thing with accounting equation. Left side has to be equal to the right side. Let me find the proper formatting here because I don't like it. That will be proper formatting. So here those negative, it's gonna move here. So in that case, if I want to increase the owner capital, I have to put on the credit side $10,000. And now my asset is equal to my liability plus equity, and also debit is equal to credit. If you follow those simple principles, debit always to be equal to credit, and asset to be equal to liability and equity, you're never gonna make a mistake. So that's with the account with here the chart of accounts and with the accounting numbers and the asset equal to liability and equity equation. Now let's start practice a little bit with debit and credit and plus and minuses. So now again, asset, if you want to increase the asset, you have to put it on the debit side. If you want to decrease the asset, you have to put it on the credit side. Now, for the liability and equity, since the normal balance is credit, if you want to increase the liability, you have to put it on the credit side. And if you want to decrease the liability, you have to put it on the debit side. For equity, is the same thing. If you want to increase the equity, you have to put it on the credit side. If you want to reduce the equity, you have to put it on the debit side. That's how this works. So every time when the owners invest capital, his account's gonna go up, and now the business owe money to the owner. But since he put it in the business cash, the cash gonna go up, which gonna help the business to start to operating because now the business has cash. And then we can add another account and another account and another account. So what's happened in this case? Beginning balance was 0. We added something. We're not deducting anything. So beginning plus the debit minus credit is going to give us the ending balance, which in this case we have $10,000 cash. No questions about it. We have it. The $10,000 cash, we have it. Now what's going to happen with the owner's capital? Well, the same thing. The owner is invested 10,000. He didn't get anything. He didn't invest another money. So right now he has $10,000. That's the ending balance here. Now, in the big picture, asset, 10,000 here, are equal to liability, which liability is 0, plus equity, which is $10,000. So we are in balance, our accounting equation is in balance, everything is perfect. And that's how we're gonna do transaction by transaction by keeping everything in balance. Means asset always to be equal to liability and equity, and debit also to be equal to, always to be equal to credit. Now, if you see in the big account here that we draw asset, liability, and equity, we have 10,000 assets, 10,000 equity. On the debit side, we have 10,000. On the credit side, we have 10,000. Let's move back to the slides. Gonna stop sharing this. Actually, let's go and do some questions now. At this point, I'm gonna go and share my screen with Blackboard, and let's do some questions there. I think we start doing some questions last time. So where you can find the questions? The questions you can find it if you scroll chapter 2, you're gonna see practice questions. And let's start with question 1. I believe we did it last time, but let's do it again. I'm gonna download this file on my computer somewhere. Chapter 2. I'm gonna open it for you, and we can start exploring this question. You can do the same. You can download it from Blackboard, and let's bring it to the screen and let's start working with it. Let's make it a little bit bigger so you don't see the answers. And at the same time that we can answer the questions. So what this question asks you, we're going to have a different type of accounts. For each name of the account, what you need to do is to identify, is it belong to asset? Is it belong to liability? Is it belong to owner's capital? Is it belong to the owner's withdrawal? Is it belong to revenue? Or is it belong to expenses? That's our objective here. I believe we did it last time, but let's do it again. Let's go with the building. What do you think building is?
Asset.
Asset. No questions about it, it's asset. How about the building repair expense? Now, every time when you see at the end expense, most likely it's expense, unless there's some exclusion. And every time when you see revenue, most likely it's revenue. When you see payable, it's most likely liability. When you see receivable, it's most likely asset. So in this case, we're seeing expenses, so that means easily expense account. No questions about it. Wages expenses. Expense again. Yes. Now wages payable.
Liability.
Clearly liability. Notes receivable.
Asset.
Absolutely asset. Then we have notes payable.
Another liability.
Another liability. So you see how it works. Notes, it can be payable, liability, or can be receivable, asset. Let's see now. Prepaid advertising, I'm going to add here expenses.
Asset.
That will be asset. Why will be asset? Because when we prepaid, now this is the key here, prepaid the expense, that means we pay in advance, but we haven't used the expense yet. For example, I pay for my insurance for the next year to drive my car, but since the year hasn't passed yet, I can still get my money from ICBC if I want to. For that reason, since it says prepaid, it's not expense yet, but is asset. Why? Because we can get the money back. But now when we have advertising expense, now you can see the difference between prepaid advertising expense and advertising expense. The only thing is prepaid. So try to put it in your mind. Every time when you see prepaid something expense, asset. Once it's only expense at the end, without prepaid at the beginning, clearly expense. Let's go with the next one. Advertising payable now. Liability, yes, no questions about it. How about unearned advertising? Let's put it here, fee, just to make it interesting. So as you can see, we have here advertising fee earned. Let's put it fees earned, and we have unearned. What's the difference?
You haven't done the advertising yet, so it's a liability.
Correct. Did you get the money here?
Yes.
Yes, you did. You get the money. But in this case, you can say in both cases, I get the money, but in the second place, I provide the service, where in the first place, I haven't provided the service yet. So if you get the money, but you haven't provided the service, can the client get his money back? Or do you technically own the client money? Yes, either you own him money, either you own him service. Make sense? So until you deliver service, that's clearly a liability for you. If you want to clear that liability, either deliver service, either get the money back to the client. Make sense? Now the advertising fee earned, that will be, now we earn it. We provide the service. What will be that for us?
Revenue?
Revenue. Absolutely. Finally, we're getting something. Revenue, right? Expenses, enough expenses. Let's go with now interest earned.
Revenue?
Revenue. Interest expense.
Expense.
Expense. Interest payable.
Liability.
Liability. What will be asset? If we want to have interest in order to make it asset, what should I put after? to make it asset. So we have interest on revenue, interest expense, interest payable liability. No, think about it. How can I make it asset? If you put prepaid interest expense, I can make it asset. To put here prepaid, make it asset. But without putting prepaid and without playing with the without playing the prepaid interest expense, how can I make it asset?
Earned? No.
If it's earned, it's going to be revenue.
Oh,
But if I put interest receivable,
oh, okay.
then it's asset. Make sense? And then we're going to have interest earned revenue, interest expense, opposite of the revenue, interest payable liability, opposite of the liability, interest receivable. Remember, receivable and payable are always the opposite. Receivable is asset, payable liability. Earned is revenue, expense is expenses. So let's go now. Earn subscription fees. In this case, we earn them.
Revenue.
Revenue. Now we have unearned subscription fee.
Liability.
Liability, clearly. Prepaid subscription fee. The one that you wanted before.
Asset.
Asset. Let's go now. Supplies.
Asset.
Asset. Supply expenses.
Expense.
Expense.
Expense. Now let's make it something. Let's think about it. What's the difference between supplies and supplies expense? What makes the supply expense? What's the action that's going to make it expense?
Buying them versus having them.
So let's think about something. Imagine you're going to the grocery store, right? You imagine you're going to the grocery store. You have cash before you go to the grocery store, or you only have cash. Obviously, we cannot eat cash. We have to buy some groceries. Let's say you buy some vegetables. Before you buy the vegetable, you have cash. Now, you don't have the cash, but you have the vegetables, correct? What will be the vegetables for you?
Asset.
Asset. When the vegetable is going to become expense,
When you pay for them.
but you already pay for them
When you consume them?
when you consume them. Do you understand this logic? When you buy
Yeah.
the groceries, the grocery become asset or supplies or inventory. Now, that inventory, you're not going to leave the grocery there. Let's say you buy apple. You want to eat that apple. Before you eat it, yes, you have it available. But once you start eating it, you don't have it available. No, what you're doing now, you're expensing it. Where's your revenue? Think about it. Do you get the revenue of having the apple in your body? Hmm? Think about people. Let's think about it. Let's say you have $2. You don't have apple. You're going to the store, so you have asset, which is cash. You're going to the store. Now you want to get something so you can have a benefit of nutrition, if water, of minerals or vitamins. Now you have $2. You're giving the $2 to somebody. Now you don't have cash, but you have an apple, which is your now supplies. Supplies of what? Of vitamin, mineral, and water. At some point, you start eating the apple. Now, apple become expense. What is your revenue?
It's what you just ate.
Hmm?
It's what you just ate.
Just eat. So basically,
Yeah.
your body is going to convert the apple and you're going to take from the apple all the minerals, all the sources that the apple has, and going to put it in your body. Make sense?
Yeah.
And what you're chasing here, the revenue to be more than expenses. So basically, the body to get more benefits than the money that you pay for the apple. And that's your accounting in the simple way of eating apple. Now let's go with the rent revenue. Rent revenue, what kind of account will be that?
Revenue.
Revenue. How about unearned rent revenue?
Liability.
Liability. Why? Because it's unearned. Clearly unearned. Let's highlight it in red. And this one was prepaid here, highlighted in red. And this is unearned, highlighted in red. Prepaid rent.
Asset.
Asset. Clearly asset. Rent payable.
Liability.
Liability. Service fees earned.
Revenue.
If it's earned, that clearly revenue, let's make it in green. Owners withdraw. For the owners withdraw, directly owners withdraw, that's a withdraw account. Owners capital, that's equity. No questions about it. Salary expenses.
Expense.
Clearly expense. Salary payable.
Liability.
Liability. Furnitures.
Asset.
Asset. Equipment.
Asset.
Still asset. Okay, great. Do you feel comfortable now?
Yes.
Okay. So now let's combine this part with this part. Since now we know which account is asset, let's think about it. What's the normal balance for that account? Remember, asset, normal balance is debit, always. And liability and equity, normal balance is credit, always.
Teacher?
Yes.
So can you explain that idea further? What do you mean when you say that asset normal balance is it's debit, you said?
Asset normal balance is debit.
Uh,
And liability and equity normal balance is always credit. Means asset always going to increase on the debit side on the T account, and liability and equity always going to increase on the credit side of the T account.
okay.
The logic is if we draw the line where the equal sign is,
Mhm.
if I draw this line and make it look like a T account, everything that stays on the left side, since the left side here on the T account is debit, on the big picture, on the counting equation, the left side is the asset, stays on the debit side. On the right side, on the equation, stays on the right side of the T account or on the credit side. So for that reason, that's how easily can remember it, that asset always normal balance will be debit, and asset always going to increase on the debit side, where liability and equity, normal balance always going to be credit, and they're always going to increase on the credit side. That means on the opposite side, they're going to decrease for the assets. If you put it on the credit side, recording, that decreased the asset. On the other side of the equation, if the credit side increasing, the debit side will be decreasing. Now, once you have this in mind, I want you to, let's go back to the blackboard. And now let's get question number 2. I'm going to download this question and I'm going to open it. And let's see if we can solve this question together. Second, before I share it with you. Okay, I believe you can see the question. Let's make it bigger. So first thing what we have to do. First, let's think about it. What kind of account is this? Is it asset? Is it liability? Is it owner's equity? Is it revenue? Is it expense? And is the normal balance debit or is the normal balance credit? Before we go here, we didn't say here on the Excel spreadsheet, I didn't tell you anything about the revenue expenses. Did I? So let's go and catch here the revenue expenses. How the revenue expenses work and where they're working in this big picture. Now the revenue generally, every time when the company starts generating revenue, that increasing the owner's capital directly. And since the owner's capital increasing on the credit side, revenue at this point for you, what I want you to remember, are always gonna be credit. Now, expenses on the other side, they're gonna decrease the owner's capital. And since they're decreasing the owner's capital, and the only way you to decrease the owner's capital on the debit side, we're gonna remember this point that expenses are always debit. Again, think about the effect on the owner. Revenue, increasing the owner's capital, and the only way to increase the owner's capital is on the credit side. Revenue is always credit. Expenses, reducing the owner's capital. So that means they're gonna go on the debit side always. There's some exemptions, but at this point, we're not gonna deal with the exemptions. You know, so every rule has exemption. When it comes to the exemption, I'll let you know. So now having this in mind, now with the asset, liability, equity, revenue, and credit, let's go and find out now what kind of account is this? Asset, liability, equity, revenue, expense, and what's the normal balance, debit or credit? Equipment,
Debit,
because it's what kind of account is?
an asset.
An asset. Let me see what I'm sharing with you. Yes, I'm sharing the right thing. Let me open the chat so I can see what you're saying. Also, equipment is clearly asset, normal balance is debit. How about land? What kind of account is?
An asset?
Asset. What's the normal balance?
Debit.
Debit, always. Owner's withdrawal. Now, the owner's withdrawal is a tricky account because that's a opposite account of the owner's capital. So withdrawals generally will be withdrawal capital, a withdrawal account, which belongs to the equity. And since the withdrawal reducing the owner's capital, balance will be debit. Expenses.
Debit.
Debit because it's expense account reducing owner's equity, so that means normal balance debit. Revenue, interest revenue,
It's revenue and a credit.
and a credit, correct. So what I want you to remember at this point, revenue, always credit, expenses, always debit. Prepaid rent, expenses,
Asset and a credit and asset and a debit.
correct. Accounts receivables, what
Asset and a debit.
asset and a debit, yes. Office supplies,
Asset and a debit.
asset and a debit. When the office supply is going to become expense? When we
they're
use it,
used.
correct. Not when we buy it, when we use it. Not receivables. It's receivable,
Asset and a debit.
correct. Next one, not payable.
Liability, credit.
Finally, we get liability and credit balance, correct. Owner's capital,
That a capital,
equity,
yeah,
and normal balance will be?
should be a credit. No,
It is credit.
yes.
No questions about it, credit. Rent earned, we earn it.
Revenue and a credit.
Revenue and credit, yes, correct. Rent payable,
Liability and a credit.
correct. Interest expense
Expense and debit.
and debit, correct. And the last one, interest payable,
Liability and a credit.
liability and credit. Excellent. Everybody comfortable with this? Okay, let's go with the next one. Now, the next one, let's go back to the Excel spreadsheet to remind ourselves few things. What is the few things? Few things are asset, normal balance is debit. So if we want to increase the asset, we have to put it on the debit side. If you want to decrease the asset, we have to put it on the credit side. Now we're moving to the other side of the equation. Liability equity, normal balance is always credit. So if I want to increase the liability or equity, I have to put it on the debit side. If I want to decrease it, I have to put it on the debit side. So increase in credit, decrease in debit side. Now, revenue, expenses. If I want to increase the revenue, which that's why we open company to increase the revenue, always going to be credit because it's going to increase the owner's capital. Expenses, are always debit. Why? Because they're decreasing the owner's capital. Withdrawals, since the withdrawals is the opposite of the owner capital, withdrawals always going to increase on the debit side in order to reduce the owner's capital. Okay, so having this in mind, let's do question 3. Let's go back to the Blackboard. From Blackboard, I'm going to crop question 3, download it, open it here on the screen, and start working with it. Share it with you. So there are a few elements of this question. First, we have to find what kind of account is this, what's the normal balance, and if you want to do the activity that they're asking, how can we do it? So not payable is what kind of account? Asset, liability, or equity? Not payable. Let me see what's saying on the chat. You're not saying anything yet. Payable, that make it liability. Normal balance is credit. So if I want to increase not payable, we have to do credit correctly, yeah, Lena. Now accounts receivable. Since we have receivable, that make it what kind of account? Asset account. So asset account. So now let's think about it. If I want to decrease asset account,
You need to credit it.
I need to credit it. So owner's capital account. You know what? Before I continue, let me do something. I'm gonna stop sharing this and I'm gonna share you the Douglas. And what I'm gonna do right now is very simple. That will be 1 and that will be 2. Just a second. I have some idea which I want to share with you. Asset, liability, equity. So what I'm gonna do is, since you see the Douglas right here on the bottom, what I'm gonna do is I'm gonna edit the content and I'm gonna add you the Excel spreadsheet I just created. Which is right here. Can you go and grab it, please? Once you grab it, what I want from you is to open it. And there are 2 worksheets. On the first worksheet is the asset, liability, and equity with 1, 2, and 3, 4 numbers. And the second worksheet is the T account and shows on which side the asset increase, decrease, what's the normal balance. Have you found it? I want you to open it on your screens. And I want we to continue now with the
It's on
question.
chapter 2, practice questions.
Yes.
And the name is, I don't see it yet.
You don't see it yet?
No.
Should be chapter 2 practice questions on the very bottom should be AL equity Excel.
You might have to
Maybe,
X out of it
maybe.
a couple of times before
Oh,
it shows
okay.
up.
Or refresh your
Is that
uh
for both sections?
which no.
Yeah.
Right now it's not. Oh, you're on the other
Oh,
section.
yeah.
Just
I'm on
oh,
the.
okay, I see.
Yeah.
I see. Going right now. Thank you for coming from the other section. Thank you. Let's go to the other section and let's show it on the other section as well. Just a second. Process. That's a nice surprise. Thank you for showing. So you're the one of those who has nothing else to do today.
Exactly.
Exactly. Okay, now you found yourself something to do. Good. It's good that you're here. Okay. Try now. I think we did this in class last time. Last
Now I
month.
see it. Thank you
Now you
very
said
much.
you're very welcome. I think we did it in class, remember? But let's
Yeah,
do it
yeah.
again.
I
Yeah,
think we did it.
yeah. Let's go back to where it was. Then chapter 2 and practice questions. And let's share my screen again. Stop sharing this. And let's share with question 3 now. Now should be a little easier, correct?
Yes.
So now when you open that Excel spreadsheet on the second worksheet on the bottom, let's go now. Having that one, let's go. Owner's capital. That's the equity account. If I want to increase the owner's capital, on which side I should increase it, on debit or credit?
Credit.
Credit. Now, unearned fees. What kind of account is this? And that's going to tell you what we have to do.
On Earth is a liability.
It's a liability. So if I want to
So
decrease the liability,
So you debit
on
it.
debit.
debit.
Oh,
Correct. Prepaid insurance. Now, the fact that it's prepaid makes it
An asset,
yeah.
so you
an
credit it.
asset. So if I want to decrease the asset, I have to credit.
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 Great. Cash. Asset.
Is an asset.
So I want to decrease it, credit. Excellent. Utility expense. I want to increase the expense account. There's only one option for the expense.
Debit.
Debit. Only debit, yes. Fees earned. We earn the fees.
Credit.
That makes it.
Because
Yeah,
it's revenue.
exactly. Store equipment. Asset. So
Debit.
we
An
have
asset.
debit. Debit, right? Owner's withdrawal. I want to increase the owner's withdrawal. Remember the owner's withdrawal, reducing the owner's capital.
Debit.
Debit. Rent payable.
Liability. So
So I want to decrease
debit.
it. Debit. Prepaid rent.
Credit.
Correct. Let's make this, get rid of this red here and just highlight the text red. If I decrease the that has to be credit, yes. Supplies. And I want to increase the supplies.
Debit.
Debit. Supplies expenses. I want to increase them.
Debit.
Debit. And I want to decrease accounts payable.
Credit.
Credit. Think about it. If I put it on credit, what's going to happen with the payable? If I put it on the credit side, it's going to increase or decrease?
If you credit accounts payable, it'll go down.
Think, check the number second worksheet. Normal balance on accounts payable is, since it's payable, normal balance.
Credit.
Credit. So if I want to decrease it, what do I have to do?
You have to debit.
I have to debit it.
Okay.
Make sense? If I credit it, it's gonna go up. But I want to decrease it. So I have to put it on debit side to go down. Make sense?
Yes. I just got it
Yes.
backwards in my head that it was receivable, not payable.
Receivable, right. Yeah. For the receivable, yes, totally
Yes.
correct. Totally correct. Totally correct. Yes. Good. If you're comfortable, how do you feel?
Good.
Good. Listen, this is a very, very important part of the old accounting process. You to understand first what kind of account is this? Is it belong to the asset? Is it belong to liability? Is it belong to equity? On the side of the debit and credit is what's the normal balance of this account? Is it debit? Is it credit? And once you know the normal balance of the account, once you identify it as asset, liability, and equity, revenue expense, then you can easily think or say asset increasing on the debit side. So if I want to decrease it, I have to go on the credit side. If it's liability, increasing on the credit side, see if I want to decrease it, I have to go on the debit side. So why we're doing all these exercises? So you can be ready to start with doing some transactions. Let me stop this sharing and let's go to the slides. Let me find them first. And let's go back to this account, the T account. Now the T account, again, is going to have a left side and the right side. Left side always going to be debit. Right side is going to be credit. The other way you should thinking if it's the left side, debit, if it's the right side, credit. Credit means right side, debit means left side. What's interesting with these accounts? Again, from the accounting equation, which is asset equal to liability and equity, if we draw the T account right in the middle where the equal sign of equal is, that split the equation on the left side and the right side. Everything which is on the left side belongs to debit. Everything which is on the right side belongs to credit. What that means? That means asset normal balance always going to be debit. On the liability and equity, normal side, normal balance always going to be credit. Also, if we want to increase the asset, we have to put it on the debit side. If you want to increase the liability and equity, we have to put it on the credit side. If you want to decrease the asset, we have to put it on the credit side now. But if we want to decrease the liability and equity, we have to put it on the left side. Example will be, simple example. Again, we have to keep the basic accounting equation in balance plus simple rule. Debit always have to be equal to the credit. If you keep that, you're always going to be correct. So this person invested cash to start the business. That's how every business starts. There's no other ways the business to start. The business needs cash. Somebody has to put the cash. Usually the bank's not going to give you the cash because they want to see operation, they want to see income, they want to see profit. So somebody has to put that cash. Usually is the owner. So the owner invested $250,000 cash in the company to start the business. So business get $250,000 cash. On the debit side, we increase in cash. Now we have to go and do something on the other side of the equation to keep it in balance. At the same time, we have to keep debit equal to credit. So we're going to credit owner's equity account and we're going to call it, that's your capital. If you want to close your capital, get the cash, close the company, go home, watch TV. If you want to run the business, put the money back in the business, start working. Then the business purchase with the cash, the business purchase land. So what's going to happen now? Cash is going to go down. Land's going to go up. So that means we're going to credit the cash with $100,000 and we're going to debit the land with $100,000. Now, nothing happened on the other side of the equation, as you can see. On the other side of the equation, we have the owner's capital to $250,000. Now, what's happened with the assets? Cash went down with 100,000 assets or $100,000. So now we have balance of $150,000 sitting in cash and $100,000 sitting in land. Total assets are 250, total liability equity 250. So first we keep debit and credit in balance, and second we keep the accounting equation in balance. Now, in the first transactions, as you can see, we are debit side, we're using asset account from one side of the equation. On the other side of the debit side, we're using account from the other side of the equation, capital or equity account. In the second transaction, we're not touching the right side of the equation. We're working only with the left side of the equation. So if something goes up, something has to go down on the left side of the equation. So cash going down, but the land's going up. If we have to put everything in the big picture, that's something interesting here. So again, left side of the equation, asset. On the debit side, goes up. On the credit side, goes down. On the right side of the equation, we have liability, owner's capital. What's happened with those two and those two only? On the credit side, they're increasing. On the debit side, decreasing. Now, the owner's withdrawal account is a special account which is related to the owner's capital. What that means is every time when we put something on the debit, it's going to increase the withdrawal, but it's going to decrease the owner's capital. For the net income accounts, what you have to understand is the revenue always increasing the capital on the credit side, and expenses always decreasing the capital on the debit side. So for the normal balance again, we already talked about this. Asset account always have debit balance. Gonna highlight it in green. Liability and equity, credit balance. Revenue account, increasing the equity, but the revenue is kind of good for the company. Actually, it's good for the owner. Expenses decreasing the revenue or decreasing the owner's capital. Withdrawals, they're decreasing owner's capital. So, in order to identify the transactions, we have to find the evidence of the transaction. Owner, if the owners come and say, I spent $200,000 to buy a laptop, is the owner's word clear and enough evidence for us to do the transaction? Obviously not. So what we're looking for? We're looking for some document. Now, with the technology level, it doesn't have to be always on paper, but at least to have to be in some format. Is it going to be electronic format? Is it going to be physical format? Whatever it is, it has to be in some form of evidence. Form of evidence can be bank records, bank deposit slip. For the purchases, any invoices or receipts, it's going to work. For the payments, any checks, anything, electronic fund transfer, emails with document for electronic transfer, e-transfer document also serve the purposes. On the sales, obviously, we have to have a document that confirms that we sold something to somebody. And that most likely will be the sales invoice. Once we have those, any form of those documents, is it going to be physical as an invoice or paper, or is it going to be electronic as an electronic file, PDF format, or any kind of format, it works. Now, how are we going to record these business transactions? We're going to, first, we have to identify, is there a transaction or not? In order to identify, we have to find the source document. Then we have to identify what account is affected and what's happened with this account. Is it increase? Is it decrease? Then we have to apply the rule, which is debit is always equal to credit first, and second, asset is equal to liability and equity. And then we have to put the journal entry to record the transaction by affecting the right amount, by making sure that the total debit must always be equal to the total credit. So the journal entry is going to include first the date of the transaction happened, accounts which were affected, amount that affect each account on the debit side, credit side, and if it's needed, short or brief explanation of the transaction. It's always helpful if you put yourself a note. Later, you can go back to that note and remember what actually happened. So now we have to start doing all those records and transactions. Again, we're gonna put it in the T account. First, once we having it as a transaction, then we're gonna put it in the T account. At the end of the period, once we have all those T account, at the end of the period, what we're gonna do is we're gonna do what we have in this account. So we have here date, account name, and explanation. Post references, it can be account number, or it can be number of transaction or journal entry following the entry number, and debit and credit, which is the amount that has to go to that account. Once we have that, then we're gonna put at the end of the period on the journal, we're gonna start from this journal, we're gonna grabbing the amount which are related to account, and we're gonna start preparing the ledger for each account. What we're chasing is what happened on the debit side, what happened on the credit side, keeping in mind that if something comes to the asset on the debit side, increase the asset, and if it goes something on the credit, decrease the asset. And at the end of the period, we have to find out what's the balance for that particular account. Same thing that you see on your bank account. Once we do this, on one page, we're going to pull out all the accounts in the order again 1, 2, 3, 4, 5, 6, 7, 8. By knowing the asset is number 1, liability number 2, owner's equity 3, revenue 4, expenses are after. And we always going to put in this order. Asset first, liability second, owner's equity third, revenue fourth, expenses after everything. Once we do that, then we're going to see how much is the balance of each account. And since asset is equal to liability and equity, and debit is always equal to credit, once we calculate all the debits and all the credits, the balance always going to be the same. And debit minus credit always have to be 0. Now, for the correcting of the trial balance error, we're going to come to this one a little bit later. Now, before we continue with anything further or those errors, let's do some practice. Because the best thing you to learn this idea with debit and credit is we to do some practices. In order to do the practice, I want you to go to, again, Blackboard, and let's open question number 4. And let's see what's sitting for us in question number 4. In question number 4, as you can see, we have some transactions to do. Finally, something interesting. Gonna save it, and I'm gonna open it. Once I open it, we're gonna start working on this question. So first thing first, let me share my screen. Let me try to find something which is called journal. Let me see if I can find here some journal. I'll post it for you. And to find something which we can use together. Just give me a quick second here. So the document, well, I want you to see it where I'm putting it. I'm gonna go to right here and let's edit it. And I'm gonna post it under those documents at the very end. Probably I have it somewhere else, but let's just in case, let's post it again. And that will be general entry to use in class. That's how the Excel spreadsheet is called. That's for one of the sections, and let's post it in the other section. So both of all of you to have it. The other thing that I'm going to post for you is called chart of accounts. Usually in class, I'm giving this chart of account, and I want you to have it all the time. Now I'm going to give it to you as a PDF document on both sections. In the section in class, next time I'm going to give it to you in class. Unfortunately for you guys which are online, I won't be able to give it to you. I want you to have it as a physical copy. So if you want, find a way to come to my office and catch me and get one of those, because I want you to use it not only in my class, but when you go further, I want you to use this document, because this document I hope is gonna, at least at the very beginning, is gonna give you a clear picture what is what. So before we're doing anything, I want to open it for you so you can see it. Can you see my screen? I believe you can see my screen, correct?
Yes.
Okay, so how can you read this document? Let me I have it here downloaded. Let me open it, and I am gonna explain this document, but I want you to, because I want you to start using this document. Every time when you're doing, at least at this level, accounting questions, it's important for me to know that you using this document. So let's stop share this and let's share, this is the document. So this is on one page, everything which we just talked about. Basically, you have accounts, all the accounts which are on the chart of account, and they coming in the order of 1, 2, 3, 4, 5, 6, 7. I told you, even 8. So what the other thing that you can see is we have two type of accounts. We have a balance sheet accounts which belong to the asset equal to liability plus equity equation. And we have income statement account which belongs to the revenue and expenses only. The other thing that I want you to see is asset account are in green, which means they're on the right side, on the left side of the equation, and normal balance is debit. It's already shown to you. Debit, debit, debit. Where the liability and equity account are on the other side of the equation. Where the normal balance is credit. Again, it's already shown. Credit, 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 credit. Now, there are always tricks. All the tricks are shown if it's an asset, normal, clear asset account. It will be in green normal text. If it's something interesting, which is something unusual, it's gonna be in italic. So allowance for doubtful account, once we go to the chapter, I believe 6, we're gonna talk about it. this particular account. But for that account, the balance, as you can see now, is credit, it's not debit, even though it's an asset account. Why is that? We have to go and see. Then we're going to have these accounts here on the accumulated depreciation, where the normal balance is credit. Why is that? Because they're companion account for the accounts above. Same thing happened with liabilities. If it's italic, that means something dragging your attention. I want you to drag your attention. Like an unearned revenue. You can, or deferred revenue. You to understand that this is clear a liability. Has nothing to do with the revenue. And the other thing is the owner's withdrawal. Owner's withdrawal, as you can see, is in black. If it's in black, that means have the opposite balance. On the opposite balance, increasing. As you know, all the equity account increasing on the credit side, but this owner's withdrawal, only that one increasing on the debit side. And expenses are expenses. But if we have here some special accounts which are related to the purchase return allowances, purchase discounts, which are part of the expense accounts, but have special balance which is on credit side. Same thing with normal revenue accounts have credit balance, but those accounts here, which are special accounts, have the opposite balance. We're going to come to this point when we start talking about the merchandising company, which dealing with those accounts. So again, in the general rule, green is the asset because that grow revenue. Red is a liability, it has to be paid. Blue is the equity because this is the water that the owners can swim and feel comfortable. Now, what increasing the equity? Revenue increasing the equity. What decreasing the equity? Expense decreasing the equity. That's why expenses are in red and the revenue accounts are in blue. That's the logic of the colors. But again, from here, you can see the most important things. This is the asset accounts, liability accounts, equity accounts. 1, 2, 3. 4 is for revenue, 5, 6, 7, 8 for the expenses. Basic equation. On the balance sheet, asset is equal to liability plus equity. Net income. On the income statement, net income is getting from the revenue minus expenses. Net income is part of the equity. How exactly happened, we're going to see later. And that's how it goes. So if the normal balance is credit, that means on the credit side increasing. On the opposite side, decreasing. You can easily draw here T account, debit, credit. Here it is not going to happen because the revenue is not side by side with the expenses. So here you cannot draw this T account. But on this side, you can draw it. That's why it's called balance sheet on this side. That's what I want you to understand, and that's what I want you to use. Contra accounts, we're going to come to this when the time comes. Right now, not too much about the contra accounts. Right now, we're going to do one question, but we're going to do the question one by one. Okay? Let me stop sharing this and let's go to another thing. And that thing will be the second document that I posted for you, which looks like this. Let me share my screen. It looks like this. So this is the general journal on the pages. So what we have to do here is start doing the transactions. Which transactions? The transactions that we have on question 4. So to make it easy, I'm going to copy those transaction question 4 and I'm going to post it right here on the site. Let's see if this is going to work. Yes, it's working. Can you guys see my screen
Yes.
with the questions?
Yes.
Excellent. Let's start working that. Now we're going to do the following transactions and we're going to start doing some accounting work. First one, this person invested cash into the business. So the first one is everything take place in March. Let's go with March. Here, let's make it, let me make it a little bit bigger. Let me make some adjustments here on this sheet because obviously that's too small. I want you to be able to see it. Let's see if this 16 is going to work. Yes, 16 works great. Those two columns I want to work as a numbers. They actually are set as a number, so all the setup is done. Just increase the font, or you can stay with the same font. March here, 2026. And now let's start with the first transaction in your probably accounting career or in your life. The owner invested $15,000 cash. Which accounts are involved? There are always two accounts involved. At least two accounts. Which accounts are involved? What the business get? Think about it.
Owner's
owner
equity and cash.
Owner's equity cash. So first account will be cash, definitely. So now, when the company get the cash, is the cash in the company increase? That's what you should ask. Yes. So if the cash increase and the cash is asset, on which side it's gonna be? On the debit side, $15,000. No questions about it. Okay, we get the first cash. Now, the next account which is involved is the owner's capital. Owner's capital also increase, but the owner's capital, as we already know, owner's capital is equity account. And on the other side of the equity, on the asset liability equation. So in order that to account to move, what we have to do? Try to horizontal text alignment. Try to make it like equal. It's going to be credit. Correct. And credit is going to be exactly the same amount, 15,000. And we're done. Correct? Debit is equal to credit. Asset is equal to equity. Let's go with the next journal entry.
Excuse me, the
Yes.
second one shouldn't be 2000?
No. We're talking about the first one.
Okay,
We're only doing the first one.
yes.
That's A.
Okay, gotcha.
Two accounts are involved. Always two accounts involved. Don't forget this.
Mhm.
Okay?
Yes.
Awesome. Why is too high? I don't like it this way. But anyway, I have to live with this. Now I don't want to change it and do. No, maybe here. Boom, done. Okay, great. Let's make everything here to be in the middle, and we're good. So let's go with the next one. Now he purchased $2,000 furnitures on account. So with the $2,000, we have to find two accounts involved. What the business get? Again, still March 2026. What the business get when he purchased the furnitures?
Assets?
What kind of assets he get? Be specific now.
Mm,
It says there,
Furniture?
furniture. How much furniture worth? He get 2,000, correct?
Mm,
Now, did he pay for the furnitures?
No.
So, which account's going to be involved here? Do we have
Oh,
to pay in the future?
yes. Liability
Accounts payable.
payable.
How much? 2,000.
2000.
Excellent. Now let's go with the next one. What's happened next? He purchased more furnitures for $500 now, but now he pay cash. What the business get?
Furniture?
Furniture, $500, correct?
Mm,
Did he pay for them?
Yes.
How he pay?
Cash?
Cash. So cash going down. So it's a cash is asset. How can I bring the cash down? Debit or credit?
Credit?
Credit, 500. Am I in
Oh,
imbalance? Is my debit equal to credit?
yes.
Yes. So one asset goes up, another asset goes down. What's happened here? One asset goes up, liability goes up. Why? Because accounts payable is liability account. And every time when we put something on the liability side, on the credit side, liability increasing. Now, the person work for the customer, provide some work for the customer, and the customer pay cash, and the business collect the cash. Now, what's happened here? We provided the service for the customer. So let's stay first with this. What the business get? What the business get?
Cash?
Cash. How much cash the business get?
1000.
$1,000. Now, why the business get the cash? Because the owner provide the services. So what will be that? Revenue. Make sense? And the revenue goes up on which side? Credit side. So how much is that credit? $1,000. Let's go with the next one. Now we still provided the work for the customer, but did the customer pay in this time?
No.
No. So what do we get now? Promise from the customer that he's gonna pay later. What will be that?
Asset.
Which asset? Accounts?
Oh, accounts receivable.
Receivable. How much? $700. Why we have accounts receivables? Because the client for which we provide the services didn't pay. So why do we have to pay? Why he has to pay? Because we provide the service, which for us is revenue. And for how much we provide the revenue? For $700. Next one. The next one we paid for what we purchased in number B, in letter B. But we pay only 500. Did we pay there for the entire purchases?
No.
No, we just pay 500. Let's pay $500. That will be should be March, and this will be 2026. So what's happened now on the debit side? Before we pay, we have to pay, right? We have accounts payable. If I want to decrease that accounts payable and we pay with cash, obviously we have to pay with cash. So if I decrease the accounts payable, on which side I'm decreasing accounts payable, on debit or credit?
Debit.
On debit side. Accounts payable, we're gonna decrease it on the debit side. Why? Because it's a liability account. On the other side of the equation, and if I want to reduce it, I have to debit it. So, accounts payable going down, 500. What else going down?
Your cash.
The cash. Before I pay, I had cash, and I had accounts payable. After I paid, I don't have accounts payable, but I don't have the cash either. Next transaction, we collecting 300 from what we did in for 700. Right? So what the business get in this case, in this in this case, when we collecting what we didn't collect before?
Cash.
What? Cash. The business get cash. How much? $300. Why the business get $300? Did we provide services here?
Yes.
Think about it.
Not with that one
Regarding
specifically.
E,
You already put it on
No,
accounts receivable.
exactly. So now I have to reduce my accounts receivables, correct?
Correct.
Accounts receivable. Now going down. $300. And the last one is we did the work for $400 for a client on credit. What that means? Did we get the cash?
No.
No. Is he gonna pay us? We have to wait and see, right? In the meantime, that for us will be accounts receivable again. And why we have accounts receivables, how much was that? That's $400. Why we have accounts receivables? Because we provide services in form of revenue. Correct? $400. Does this make sense?
Yes.
So now watch this. The next thing that we're gonna do, once I have this, once I have all this shit, what I'm gonna do and what I want, are you with me, guys? Are you where I am?
Yep.
yes.
Everybody's where I am. What I want you to do is get the sheet and copy it and flip it here. So you can have two worksheets with the same information. The next thing that I want you to do is grab the entire sheet and formatting was a little bit smaller. Let's go with the number with 10 font. It's kind of too small, but what I want you to do is reformat the entire sheet. So I want to see the entire sheet on that, grab all the cells and make it a little bit smaller. So we can have it on a small version of this. Why we need a small version, I'm going to explain just a little bit later. And you're going to get the idea. I want it to be like this. Now, these questions, I don't need it anymore. What I need, though, is to create the T accounts. And I'm going to create the T accounts for cash, obviously. Let me create it faster, and I'm going to share it's going to send you this sheet. So that will be easy. So I'm going to have here cash. Let me fill it as fast as I can, and I'm going to send it to you. That will be my cash. Then I need here accounts receivables. Then I need another account which will be furnitures. But before I do that, I need here debit and I need here credit. Debit and credit. I need here beginning balance and I need here ending balance. Now I can multiply this information 1 and 2 times furnitures. Then I need accounts payable, which accounts payable now the beginning balance is on this side and ending balance is on this side. Then I need revenue account. Now the revenue account doesn't have beginning balance, doesn't have ending balance. It's just a revenue. And we don't have expenses, do we? No. Okay, those are the accounts that I need. That's accounts receivables and that's equipment. Let me see how I need capital. I'm missing one account. Accounts payable here. I need this revenue from here to move right here. And I need here copy, paste this one here, and that will be capital. Let me see anything else, revenue accounts, receivable revenue accounts, payable, cash. So probably here, since we're dealing with so many caches, I need a little bit more cells here. Let's push it down, insert down, and I have everything that I need. Okay, now since I have this on my computer, I'm gonna save it on my computer and I'm gonna post it for you so you can have it, okay? And let me show you where I'm gonna post it and now you can use it. So that will be after the chart of account on one page. Then gonna be a new this is the one, but then with duplication, but that's okay. Okay. So now you have two journal entry to use in class. The second one, use the second one, please. Let me save it. And now the first class has it. Let me see which one I am. The class from today has it. The evening class. Now let's post it I'm gonna post it for the day class. And day class also gonna have it. And now we can start working with this. Can you guys find it? Again, it's on the course content, chapter 2, on the practice questions, all the way at the end, the last one. So when you open the last one, you should be able to see this document. Can you find it?
Yes.
And when you open on the second sheet, is that what you see? There are two worksheets. On the second worksheet, you should see this T account. Is that what you guys see?
Yes.
Excellent. So now, on the first worksheet, we did the journal entries, right? Now on the second worksheet, we're gonna grab this journal entry and we're gonna put it in the right accounts. So in the very beginning, since the first time the business, all the accounts has a zero balance. Cash is zero, accounts receivable zero, equipment is zero. Now the liability is, which is accounts payable, is zero, owner's capital zero. For the revenue, there's no beginning balance, no ending balance. Because it's not balance sheet account, but we're gonna come to that one later. So now, cash. What's happened with cash? The first thing that happened with cash is, first we collect the cash. How much cash we collected? We collected $15,000, correct? Goes on the debit side, increasing the cash. That was the transaction A. If you want to put it that way, you can go transaction A. Now, cash increase, but we put it in the capital. So the capital also increase with the same amount. And that's what's happened with the capital. Then we get the furnitures, which is our equipment. Now we can change it from instead of equipment, we can change it to the furnitures. And first we get $2,000 of furnitures. And for which we didn't pay, so accounts payable went up with $2,000. And the second transaction is posted to the ledger. Next one, we get more furnitures, $500 came more furnitures. But this time cash went down. So the cash going down with $500. Next transaction, cash going up, $1,000 cash going up. Why? Because now we have a revenue for $1,000. Then what's happening is accounts receivables going up with $700. Why? Because we're generating more revenue, but we didn't collect the revenue. And that create accounts receivables. Then accounts payable went down with 500 on the credit side because we use $500 cash. And we use the $500 cash. Next thing what happened is cash went up with 300. Why? Because this client decided to pay. Accounts receivables going down 300. And the last thing is accounts receivables went up again with 400. Why? Because we provide more revenue for $400. Did you guys see what I did? Was it too fast or you following me? So now, as you can see, I have all these different accounts. Beginning balance, 0. And then I have debit and I have credit. And I have debit and I have credit. And I have debit and I have credit. And I have debit and I have credit. Now what I have to find out is what's the ending balance. How can I find what's the ending balance? Very simple. I'm gonna leave some space here. I'm gonna insert few rows here. And I'm gonna push everything down. And here I'm gonna put you the formula. How this works is, and always works this way. Beginning balance plus all the debits, it's always equal to the credit plus the ending balance. Now this one's gonna give me trouble, but if you go to format cells and alignment and I don't want to wrap the text, I want to this, justify, cancel, then why it doesn't help me. Here you go. Just put it on the other cell. So this is the basic formula. Beginning balance plus the total debits, it's always equal to the credits plus the ending balance. Now the question is, from this formula, can I find out the formula for the ending balance? Obviously, the ending balance here will be equal to beginning balance. Here we go again. So let's format this one and flip it here. Beginning ending balance is going to be equal to the beginning balance plus all the debits minus all the credits. So what I have to do here, I just have to put the formula, which is the formula beginning balance plus bracket sum of all the debits, close the bracket, and close the other bracket, minus bracket sum of all the credits, close the first bracket, second bracket, equal to $15,300. What that means? That means is all the cash that I get minus the cash that I paid. Currently, I have $15,300 cash. Now, since I made a mistake here and put everything on the accounts receivables under the furnitures, I'm gonna go and change this one because this is related to the accounts receivables, not to the furnitures. So In that case, what I'm going to chase accounts receivable, have these $700 accounts receivables. Then I collect $300 in accounts receivables here. And then I get another $400 accounts receivables, which are here. Now, since I have the correct numbers on the accounts receivables, I can easily copy this cell and paste it here. So what that means, the services that I provide for which I didn't collect the cash, minus the cash that I collected, it gives me $800. So I have to collect $800 of accounts receivables. So let's double check quickly. Beginning balance 0, 700 plus 400, 1,100 minus 300, 800. We are correct. Then we're going to copy this cell and we're going to move it here. And that's going to tell me that the furnitures, beginning I have 0, then I purchased 2,000, then another 500. So the total value of the furnitures that I have is $2,500. Now, these formulas are correct, but only for these accounts, which are the asset accounts, as you can see. Now, let's see for the liability accounts what's going to work. Now, since the liability account, the normal balance now is not debit, it's credit, we have to make some adjustment in the formula. What will be that? The adjustment will be very simple. In the liability account, beginning balance plus the credit should be equal to the debit minus ending balance. And let's put this one in red, just to drag your attention. So how are we going to get the ending balance? Very simple. Ending balance here is going to be equal to beginning balance plus credits now minus the debit. And that's how we're going to get it. So the ending balance here should be equal to beginning balance plus sum of bracket all the credits, close the bracket, minus sum of all the debits, close the bracket. $1,500. So let's double check this one to see if we are correct. In the beginning, we don't have to pay. We purchase equipment for which we didn't pay $2,000. Then we pay 500. We still have to pay 1,500, which is correct, for more works. So I can copy this formula and flip it to the other account, which is related to the other side of the accounting equation, which is the owner's capital. And the owner's capital in the beginning was 0. Then the owner is invested $15,000. So his capital is $15,000. Now, if I want to follow the sheet with the accounts that I gave you, I'm going to highlight this one in reddish kind of color. And I'm going to highlight this one in the blue kind of color. The last thing that we have is the revenue. For the revenue, it's easy. There's no beginning, no ending balance. So I'm just going to copy this one and I'm going to paste it. So my revenue, total revenue is 2,100. And since the revenue increasing the owner's equity, let's put it also in. So now what I have is, I have the general journal, which shows me which accounts are involved, how much is debit, how much is credit. Then I have this kind of ledger, which gives me information for each account based on the general journal, how much is the beginning balance, how much is the debit, how much is the credit, how much is the ending balance. for each account that are involved in all the transactions. Now, the other thing that I can do is, if you want to go one step further, I'm going to flip this one and create another copy, which will be the third sheet now. So once I have all those accounts, what I can do is I can prepare my trial balance. How can I do that? I can easily, actually, what I can do is I can grab this part and only this part. Probably that will be more than enough. Copy it. And I'm going to flip it right here and see what's going to happen. Right now, give me numbers, which I don't want. And what I can do is I'm going to make it a little bit bigger. So, in order this one to be trial balance, I'm going to delete everything. I'm going to still have the accounts, only the accounts. I don't need this column, but I'll leave it just in case, and debit and credit. So what I'm going to do now here, I'm going to label it trial balance. And I'm going to start listing all the accounts. First account that I have is cash. Second account that I have is accounts receivables. Third account that I have is furniture. Next account that I have is accounts payable. After that I have owner's capital. And after that I have is revenue account. Now I can make those one a little bit bigger so you can see it as well. And those are all the accounts that I have. So what I'm going to do now in this trial balance, I'm going to transfer only and only the ending balances for each account. So for the cash, my ending balance is $15,300. For account debit, as you can see, it's clearly debit. For the accounts receivables, my ending balance is also on the debit side, $800. For furnitures, my balance is also on the debit side, $2,500. And those are my assets account. I don't have any other assets account. Then next account that I have is the accounts payable. But accounts payable, as you can see, the balance is on the credit side. So I need here, credit side, $1,500. Next account that I have is the owner's capital, but again, that's a credit. So let's put it on the credit side. And the last account that I have is the revenue, which also is on the credit side. So let's put this revenue here and see what's going to happen. 2,100. Now, if we work correctly, once I run the totals, the total debit has to be equal to the total credit. So we're going to see here totals. And let's see if that's going to be the case. Total is $18,600 debit. And now we have to get the same amount here. And if we get the same amount, that means we work correctly from the start here through transferring all the amounts in the accounts, calculating the balances correctly, getting the ending balances only, and preparing the trial balance, which in this case will be unadjusted. . trial balance. So now, if this person asks you, what happened in my company, you can easily clearly say, tell him, to this point, the company generating revenue, $2,100. Your capital is still 15,000. You have to pay $1,500. The assets of the company are cash, accounts receivables, and furnitures. Total assets are $18,600. Out of those assets, once you pay your accounts payable, the rest is yours. And that's your very, very, very basic accounting, how from the transactions with debit and credit, then posting debit and credit in the right accounts, the accounts, calculating the ending balance of each account, putting everything on the unadjusted trial balance, and getting and matching the totals. Now I can eliminate those one because I don't need them anymore. Those now are not important to me. Are you guys with me? Now I can post you this solution, correct? But before I post it, let me rename those sheets. So that's where we're going to stop. At this point, we're going to stop with this unadjusted trial balance. And following classes, we're going to start making one step further. We're going to do some adjusting entries. And then we're going to prepare financial statements. Now, before we do the adjusting entries, I want we to go over more questions like this: debit, credit, debit, credit, debit, credit, debit, credit first, moving it to the T accounts, calculating the balances of the T accounts, and getting the unadjusted trial balance. I know it seems like a boring stuff, but I want you to get exposure to more simple transactions so you can get more comfortable with this debit and credit, debit and credit, debit and credit. This is the first time that we're doing debit and credit. Probably this is the first time in your life that you're doing debit and credit. So if you are able to follow me and if you are able to get where I am, excellent. If you're not, still great job. Now I'm going to post you the answer and you're going to have it as an answer. Now let me show you what what the answer is gonna be. So you can go there and just download it. You'll be. So the answer is gonna be right here. One of you already have it, one of the groups. Now let's post it to the other group. And both sections now is gonna have it. Can you guys find it?